Hello and welcome to the Profitable Baker podcast, the show for bakers who mean business. I'm Annie Bennett, founder of the Home Baking Business Academy, and every week I'll be sharing practical lessons, mindset shifts, and inspiring stories from bakers who are building businesses they love. Because success in this industry isn't about who bakes the fanciest cakes, it's about who builds the strongest business foundations. Let's get started. Hello and welcome back to the Profitable Baker podcast with me, Annie Bennett. Now, if you've been following along this April, you'll know we've been spending the month on the financial side of running a home baking business. We've covered expenses, record keeping, and the tax changes that are on the horizon. Today, I want to bring it all together and talk about what all of that preparation actually leads to the moment you file your self-assessment return and find out what you owe. But before I get into it, I want to start with something that I think is genuinely important. And that's making sure we're all on the same page about when any of this actually applies to you. Because one of the most common sources of confusion I come across is around timing. When does your first tax bill arrive? When do you need to pay? And if you're brand new to running a baking business, is January the deadline you need to be thinking about? Now, the answer for many newer bakers is it's not as soon as you might think. And I want to explain that properly before we go any further. So this is for our new bakers. If you're established and you've been submitting your self-assessments for a while, you should know the timings and the routines by now. So just listen along. This won't take very long. Now, let me start with the basics because I think they're worth saying clearly, even if some of you already know it, because the confusion here is so common and so understandable. The UK tax year runs from the 6th of April to the 5th of April the following year. There is a historical reason why it's those weird dates, but I won't go into that now. So the tax year we're currently in, as I record this, runs from April 2026 to April 2027. We've just started the new tax year. When this tax year ends, you will then have until the 31st of January the following year to file your self-assessment return online and pay any tax you owe for that year. So for the tax year ending next April 2027, the deadline is January 2028. Now here's the part that matters if you're newer to self-employment. Let's say you set up your baking business in August 2026. You start taking orders, you start generating income. Brilliant. But that income falls in the tax year 2026 to 27, which means your first self-assessment return for that income isn't due until January 2028. So if you start your business in the second half of 2026, and you're sitting here worrying you need to submit something a few months after, you don't. You have time. The tax follows the tax year and the deadline follows the tax year end. I say this because I've spoken to bakers who've started a business, say in the autumn, and genuinely believe they needed to file a tax return the following January. That misunderstanding creates panic and sometimes leads people to rush into filing before they actually need to, before they have a full picture of their income and expenses. So your first tax bill is for your first full or partial tax year of trading. And you have until the January after that year ends to file and pay, not before. So with that foundation in place, let's talk about what that bill actually looks like when it does arrive. Here's a scenario I want you to imagine. A baker has been running her business for a couple of years. She's got a reasonable handle on her finances. She knows a tax bill is coming and she's broadly prepared for it. She logs into her HMRC account on the day she's ready to pay, and the figure on the screen is significantly higher than she was expecting. Not a bit higher, a lot higher. And she genuinely cannot work out where the extra has come from. Now, if that sounds familiar, all you established bakers out there are knowing what I'm going to be talking about now. This episode is going to explain exactly what that's all about because that baker isn't looking at one bill, she's looking at two. And understanding the difference between them is one of the most useful things you can do to take the fear out of that moment. So the first bill is the one most people are aware of, at least in broad terms. It's your income tax and national insurance for the tax year that's just ended. I want to spend a moment on national insurance specifically because it works quite differently for sole traders than it does for people in employment. And I think it's worth being really clear on this. When you're employed, your employer deducts your national insurance from your wages automatically and pays an additional employer contribution on top. You can see it on your pay slip, and for most people, you don't really think about it much. But when you're self-employed, there's no employer to handle any of that. You're responsible for your own national insurance, and it comes through your self-assessment return, not separately. Now, there are two types of national insurance that may apply to you as a sole trader. The first is Class 2 national insurance. Now, if your profits are 6,845 or more in a year, your Class 2 contributions are treated as having been paid to protect your national insurance record. This means you don't have to pay any Class 2 contributions if your profits are above this amount, and that's profits, not turnover. If they are below, you don't have to pay, but you can if you wish. You can volunteer if you wish. It's a flat weekly amount, and it applies if your profits are above what the HMRC calls the small profits threshold. That's 6,845. It's a relatively modest sum, the weekly amount. I think it's £3.50, but it matters because it's what counts towards your state pension entitlement and certain other benefits. A lot of bakers are surprised to learn that their national insurance contributions as a self-employed person build towards their state pension in exactly the same way as if they were self-employed. So that makes it feel a lot less like tax and a bit more like something that's actually working for you. The second national insurance type is Class 4. This one is calculated as a percentage of your profits above a certain threshold. It scales with your income. So as your baking business grows and your profits increase, your Class 4 bill increases with them. And because it comes through self-assessment rather than separately, it sits inside that total bill figure when you go to pay. This is part of why the bill can feel higher than expected. It's not just the income tax, it's income tax plus your Class 2 national insurance plus your Class 4 national insurance, all wrapped up in the same total, all due at the same time. So that's bill number one, your tax and national insurance. Now, bill number two is what the HMRC calls payments on account. And this, in my experience, is the one that catches people off guard because it's genuinely not intuitive until someone explains it to you. The HMRC doesn't want to start waiting until the following January to start collecting the tax you'll owe for the current tax year. So once your tax bill reaches a certain level, they ask you to start paying towards next year's bill in advance, in two instalments, one in January, one in July. Each payment on account is calculated as half of your previous tax bill. Let me make that concrete with an example. So imagine your self-assessment bill comes to £2,000 for the year. That's your bill for the year that's just ended, say. But HMRC then says, we'd like to take half of your estimated bill for the year you're currently in. So they add a payment on account of £1,000, half of that 2,000, due at the same time as your year-end bill, which means that instead of paying 2,000, you're now paying 3,000. 2,000 for the year just gone, 1,000 towards the year that you're currently in that you'll be paying and submitting your self-assessment for next year. And then a further £1,000 in July as the second payment on account. Now, for someone who isn't expecting this, that first experience of payments on account can feel like being hit from two directions at once. But I want to be clear about when payments on account actually kick in, because they don't apply to everyone. And if you're earlier in your business journey, they may not apply to you yet. Payments on account are triggered when your tax bill for the year, the amount collected through self-assessment, is over £1,000. So that's your tax bill, not your turnover, not your profits, but your tax bill. If your bill is under that amount, you simply pay what you owe and that's it. No advance payments. There's also a second condition. Payments on account only apply if at least 80% of your tax was collected through self-assessment rather than through PAYE from an employed job. So if you have employment alongside your baking business and a lot of tax is already being collected through your wages, your self-assessment bill alone might not trigger payments on account. But for home bakers whose baking income is their primary or sole source of self-employment income and whose business is generating meaningful profit, payments on account are something you're likely to encounter as the business grows. Knowing what they are before you first see them is infinitely better than trying to make sense of them on the day the bill arrives. Now, I want to address something head on because I've seen it cause genuine distress and I don't think it needs to. The first time payments on account appear, it can seem deeply unfair. You've worked hard, you've filed your return honestly, you've accepted what you owe for the year and you were prepared to pay it. And then the HMRC adds half of next year's bill on top for a year that hasn't even finished yet. That feeling is completely understandable, but here's a reframe that I think genuinely helps. Payments on account are not additional tax. They're not a penalty. They're not the HMRC taking more than you owe. They are an advance payment of tax that you will genuinely owe. The money you pay as payments on account is credited against your next self-assessment bill. So when that next bill arrives, you've already paid a significant portion of it. And instead of owing the full amount again, you're only topping up the difference. In the first year you encounter them, yes, it feels like a double hit, but in subsequent years, the rhythm evens out. You've been paying forward throughout the year, and the bill, when it arrives, is manageable because of it. So what can you actually do to prepare for all this? The most useful thing, and you'll have heard this across the whole series, I'm always banging on about it, is to know your numbers throughout the year. If you've been tracking your income and expenses consistently, you can make a reasonable estimate of what your bill is going to look like well before it arrives, which means you can set money aside for it, including the payments on account if they apply to you. A practical approach that many sole traders find helpful is to put aside a percentage of every payment you receive into a dedicated savings account, one that you won't dip into specifically for tax. The right percentage depends on your profit level, but somewhere between 20 and 30% is a reasonable starting point for most bakers at small to medium scale. It's not a precise figure, but having a pot that's been building throughout the year is a very different experience to trying to find a large sum all at once. The second thing to know that if your income drops significantly from one year to the next, you can apply to reduce your payments on account. This is a legitimate option available through your HMRC account, and it means that if your bill for the current year is genuinely going to be lower than previous year because your income has dropped or your expenses have increased, you can ask the HMRC to reduce the advance payments accordingly. A word of caution though, if you reduce your payments on account and it turns out your bill is actually higher, you'll owe interest on the underpayment. So this isn't something to do speculatively, but if your circumstances have genuinely changed, it's there to be used. Now, I just want to come back to national insurance one more time, because I think it's easy to understand in theory, but easy to underestimate in practice. Class 4 national insurance scales with your profits. As your baking business grows, the national insurance element of your bill grows with it. And because it arrives wrapped inside the same self-assessment total as your income tax, not labelled separately, not on a different bill, it's part of that figure that can feel higher than expected if you've only been mentally preparing for the income tax portion. The practical takeaway is this: when you're estimating your bill throughout the year, don't only think about income tax, factor in national insurance too. A rough combined estimate is more useful than a precise income tax estimate that leaves out national insurance entirely. That is why I always suggest around 30% saving as you go through the year, because that is more likely to cover what you will actually owe. So let me bring this together with a simple framework. If you're early in your baking business, income modest, profits below the payments on account threshold, your self-assessment bill is going to be single, manageable figure, income tax and national insurance on your profit for the year. Provided you've kept decent records and you know your numbers, this should be entirely predictable. The main thing is to make sure you're registered for self-assessment, you file on time, and you're clear on which tax year your income falls. If your business is growing, profits building, bill likely to exceed £1,000, this is the time to understand payments on account, not because they're complicated, but because knowing the mechanism means you won't be startled when they appear. Start setting money aside now, not in the month before your return is due. And if you're already in the payments on account cycle and it feels like a bit of a scramble, the answer is almost always the same. Earlier awareness, consistent saving, knowing your numbers before the return rather than during it. None of this requires you to become an accountant. It requires you to understand the shape of what's coming. And that's what this episode has been about. Now, if you've been listening to this episode and thinking, help, I need to understand this properly and actually apply it to my business, then I want to point you toward what's happening inside the Academy membership this month. Throughout April, we've had a full financial programme. We've covered allowable expenses, record keeping, tax changes, and in our dedicated session on national insurance and payments on account, I went exactly into what we've talked about today with practical detail you'll need to apply to your specific situation. And if your self-assessment bill has ever felt like something that happens to you rather than something you're ready for, that session is worth being inside the Academy for. And I'll also be doing a step-by-step through a self-assessment for anybody that has never done one before, even for people that have done one before, because doing something a year ago, you often forget what it's all about. So that is inside the Academy as well. And all the details of the Academy are in the show notes. Thank you so much for listening to today's episode and for following along with the whole April Finance series. I hope it's left you feeling more informed and a good deal less anxious about the numbers side of your business. That's genuinely what it was designed to do. I'll be back next week with the next episode. Until then, take care of yourselves and maybe start that tax savings pot if you haven't already. Until next time.